Alrighty, so I wanted to show how I gained 17.7% in the last 3 months. So this is just some code I made up. I gained this from a CSV file you can import from Yahoo Finance. It would look like this, but if you put in this code, this line is reading the CSV. This is transposing because you need to do this because originally the CSV files look like this and it just won't work. After you get all that done, it looks like this, all nice and clean. And then all of this down here is the exact same thing, but it's for other companies in the same industry. It says TJ Maxx, Ross, Lulu, Burlington, and Gap. You don't need to know too much about this code other than it averages out the PE ratios, PEG ratios, PS ratios, PB ratios. It also determines right here if the enterprise value divided by EBITDA ratio is lower than 10. You just want to know that because that's a clear indicator of undervaluation. Now, this code will only run if all conditions are met, which the conditions are PE, PB, PS, PG, and enterprise value divided by EBITDA all at the same time. It has to have lower ratios than their average industry competitor. So we can see that I named a few days ago's date this because it will only take in months or current. You don't want to really say it's current because that won't make sense for the code to use. It has to use a date. So I just named it 2 days ago. And it's saying the current evaluation is hitting all the requirements. PE is lower than the average industry value. PEG is lower than the average industry value. PS, PB, and so on. So now, after you get a stock, all you have to do is look up its financials, which the main ones you want to look at are P divided by FCF, which is price to free cash flow. And then there's a couple websites. I'd recommend Stock Analysis. Yeah, it gives you everything you really need. So right here, it gave us our PFCF, and it's telling us it's pretty high, but you don't really want it to be too high. You want it to be in the lower range, I believe. And then you have PE or ROE ratio, which is really high. So here you have to make a decision. ROE is showing really, really good performance. And it's not in the hundreds, which would give an indicator that something's extremely wrong in the company. Another thing you can do is search up their competitors, ROE, and then compared to them, it's around 15 points less than theirs, and then their PFCF ratio is actually better than us, but return on equity is pretty good for Lulu. And then after you figure that out, you just got to decide whether you want to buy it or not. Sometimes I like to do this where I check it's more consistently around a 300 level, and right now it's at like a 210 level. So I would say it's definitely a buy. I think right now the tariff scare is throwing it off, which is making it cheap, which is also contributing to its valuations on all its low industry low PE, PS, and PB. All right. Thank you for watching.